there.
Hi, everybody. How you doing? I'm here.
Awesome. Perfect. I know that David from American Funds was going to join us, but he's having some difficulties. So we will go ahead and get started. And I know we still have some people logging in. We are recording this just in case we miss anybody, we can send it out to you. There is a question and answer box at the bottom. So if anyone wants to type in questions, we can try to answer questions along the way and at a minimum, make sure we answer them at the end. But just wanted to say thank you to everybody. I know it's been an interesting year with, another year or two into this COVID pandemic. And so unable to do as many of our client in-person events as we would like to. And we typically do like to have Phil Blancato of Ladenburg Thalmann Asset Management and give us an economic update as well as a market update. Typically, we like to do this in person at least every other year. And for those of you that aren't able to make it to an in-person event and just to reach more people at home, we wanted to have Phil provide this update via Zoom. We also have Jim Cunningham with us of CunninghamLegal. And so we have a lot of mutual clients that we share. And I know Jim certainly has some good questions for Phil. So without further ado, Phil, would you go ahead and kick us off with an economic update and a market update? And then if American Funds is able to hop on, then we'll add them at a later time.
Great. Well, first of all, thank you for having me. Good to see you, Christina and Jim and everyone else out there. One of the things that makes these presentations fun, if perhaps we've spoken to each other in the past, is, I'm always a big fan of taking questions. At the bottom of your screen, you see there's a chat box and there's a Q&A box. Feel free at any point to type in your question as I just kind of barely talk about the economy and where we see things going. I'd love to have some feedback with you. I can even unmute you if you want to do that live and just raise your hand. You see there's a spot down there to raise your hand as well, and I'll see that. And I'll be able to unmute you as well and get a chance to or have a conversation with you. So whatever you prefer. I jump in by saying inevitably, we are still dealing with so many things that are new and different. And as Christina just said a minute ago, we like to see you all in person, but that's not always so simple. And we continue to focus on the fact that inevitably, the economy and COVID are still directly tied together. And when we look at some of the ebbs and flows of the data around it, it just seems like it's a constant battle. And the fact of the matter is, whether it's some of the new drugs coming to market, that'll be a pill form. Just yesterday, Pfizer went to ask for emergency use authorization on their new pill form for someone who does get COVID. And that particular drug actually has a 93% success rate for folks who have the potential to be hospitalized. So really high efficacy on a pill form that's a 4-day regime. That's exciting news. But the fact of the matter is, we are still in the throes of different outbreaks around the world, and much of that affects the supply chain. For example, Singapore has been battling a quite significant breakout. It's come back down recently, but there are real restrictions in place. Right now, Vietnam continuing to battle outbreaks as well with real restrictions in place, quite severe, in fact, in some places. Oddly enough, New Zealand. What we're seeing is countries that took a very pragmatic approach to the virus, like Germany, New Zealand, Australia, are having real outbreaks because of the Delta variant, simply because what they tried to do was not have the virus enter their country at all, and that just didn't work. Inevitably, the virus has found its way there, and once there, it does spread. And we know that folks who have been vaccinated have this sort of mild breakthrough case, which creates this concern about how fast and how wide we can open. Germany has more new cases today than any time during the pandemic. The UK had come down to around a few thousand cases a day and now back to around 30,000 cases a day. What's interesting, though, is that when you look at the folks going to the hospital versus the folks who are getting new cases, it's a quite wide variance. What we're not seeing is a real increase in hospitalizations and fatalities. My point is, when you look at some of the vaccination rate, the United States is still one of the lower countries from a vaccination standpoint. More importantly, the folks who are most vulnerable are predominantly vaccinated. So if you look at my slide on the left there, folks 65 and up now, at least 99% have one shot of the vaccine and 86% double. And we know clearly that it suggests that those are the folks who are more than likely susceptible to it. My point, they even mentioned COVID, is because unfortunately we still have to. And it is interesting though, when you think about the impact of COVID, specifically the Delta variant, for economics, it was actually a pretty good thing. And I know that sounds strange, but let me explain why. You see, we expected quite euphoric spending in the second half of this year. In fact, we thought the GDP for the third quarter of the United States would be somewhere around 6%, when in fact, it didn't. It came in quite different than that. It missed expectations by a heck of a lot. And why that's relevant is because when we think about the impact of COVID, certainly it's got its human role, but from an economic standpoint, how long will it take us to recovery? Well, you all heard the comments about inflation. You've all heard about supply chain issues, but specifically, when do we get to a point where we can once again be able to have an economy that runs normal? So today I want to talk a lot about normal, and why that's so important is the spending that didn't happen in the third quarter of 2021 is going to get pulled forward to the first and second quarter, and to a degree, the last quarter of 2022. But notice this chart. It's probably, if nothing else, I want you to really spend some time here, because if you look at that bar chart, notice in Q3 2021, we expected that red line to be 7%, when in fact the final estimate is going to be actually below 3. This was an early an estimate before we have the final number. In fact, it came in just north of 2. Q4, we should get a pretty strong Q4, roughly around 5 to 6%. But notice Q1 of 2022. Notice how in the beginning of the year, it's going to be going right about that 5 to 6% range, and then end up down by about 2. What we expect next year is that this euphoric growth that we've been having in our economy is going to slow down and go back to normal. And what does normal mean? Well, if we look at 21, 22, 23, and 24, normal means 2% growth rate. Notice how we've come down significantly. In the second quarter of 2021, earnings growth on the S&P 500 was just around 100%, 92% to be specific. So if you were in a company and in the first quarter of that year, you made $1, you basically made $2 in the second quarter. Oh, and by the way, the third quarter, you added another 40 cents. Some of the greatest growth in our lifetime. And we really did need that growth because the stock market has had 3 fantastic years. Now think about that. Remember, 2018 was a positive year for the market. 2019 was an unbelievable year with 31% rates of return. And now 2020 ended up nearly 20% rate of return. And 2021, we're over 26% now, or just about that. So when we think about those euphoric returns, it's much because of the amount of money that's been pumped into the system by the federal government and the success of the U.S. economy at navigating COVID. I know that might sound crazy, but the U.S. economy right now is in really quite strong shape. And when you think about Q4, it's going to be emblematic of how strong we are. When we think about all the things that are affecting us right now, in spite of the supply chain, in spite of, my gosh, driving here to visit Christina yesterday, I saw gasoline over $5 a gallon for regular. In New Jersey, where I live, we pay about $3.30. Depending on where you live, your gasoline charge is up anywhere from 100% to about 40%. So where I live in New Jersey, we're up about just about 60% year over year. Here in California, even more. So whether it's gasoline or it's food, we can go through the different products, but whether it's poultry up 30%, pork nearly 40%, beef around 28%, used cars 30%, and on houses. Houses are a great example of up over 20% to an all-time high in houses. So when we think about all these impacts, it does represent an economy that's run strong, in spite of the Delta variant continuing to run strong. Some of that spending being pulled into the new year, which is a good thing. We want to have a softer landing as the economy goes back to normal. We didn't want to see a tremendous surge in spending all at once and then come back to normal much more quickly. Having a methodical slowdown over time back to normal is the best thing for the economy. And what's happening along the way, there's breakage. Because of all this money that's in the system, and you think about all the money that the federal government's printed, I'm going to show you a slide in a minute that talks about that. Think about consumers and how much they have to save. Today, we as a country are worth $150 trillion. That's the most in human history, the most we've ever been as a country. We have amassed significant wealth. Now, is that because of what the federal government did to get us here? Is that because we survived COVID quite well, leaving the human impact aside of speaking squarely on economics? Or is that because we were the country with the greatest wealth going into us and then did that much better going out? Really a combination of it all. But the breakage from COVID is still being felt. So on one hand, you have high savings rates, you have strong economic growth, but on the other hand, we have high costs. And whether it's, if someone I was just speaking with this morning that talked about how the costs of the goods that they're using for their home are up 40% year over year, or it's just the idea that just getting things that you live on every single day are still not simple. And this is the picture I took when I happened to be in Southern California. I was just north of Emerald Bay, and taking a picture of all these beautiful, beautiful sights, wonderful ocean, great scenic view, and what's in the background? Cargo ship after cargo ship after cargo ship. Just yesterday, flying in here to visit with you all, you could still see a mass of ships in the harbor. Now, in fairness to the guys in the ports, they're actually bringing more goods through the ports today than they ever have before. It's just the demand is so high, and the shelves in many places are empty. Inventory restocking will be the number one driver of economic growth after consumer spending for the entire next year. Companies trying to build back that excess supply that they need for you can have on-demand goods is going to take time. And we're seeing actually there's been a 24% improvement over the last 2 weeks in the number of ships in the harbor, where we went from anywhere from a 3 to 4 month delay to now you're down to anywhere from a 2 week to 8 week delay. And in some cases, even faster than that. The East Coast has improved quite significantly. But a lot of this is due to the fact of the matter is we just simply have breakage left in the system. And by that, when we think about what got us here, we know what COVID did, but how did we survive it? How do we survive this inflationary aspect? And how do we, get to the other side? How much really is transitory, meaning it's somewhat temporary, and how much of it is permanent? Well, the transitory aspect plays very much into the supply chain. If those ships get offloaded, then some of those things you want to be available to you. But the other thing that creates inflation is the amount of money the federal government has pumped into the system. And when you think about the last few years, it is quite incredible how much money has really gone in. And if you look at the chart on the left there, from just pure general actions, $1 trillion just to keep things working, potentially we've already spent $4.6 trillion on different types of stimulus bills, and then additional $3.6 trillion on government spending, money being amassed at the Federal Reserve. You total it all up, and you're sitting at around $8 trillion that's been pumped into the US economy. And it's different types of lending facilities, it's stimulus programs, it's money lent to businesses, corporations, and people that's not going to be paid back, or it's simply the federal government printing money at the Federal Reserve to keep the economy afloat. A very debatable point. How much of this really is necessary or was necessary? How much of it is things that we probably no longer need? Key point here. As the economy slows down, as the supply chain mends itself, what is permanent versus transitory? Well, permanent means wages. Wages are up 6% on average year over year. That's the best number since the 70s. When you look at savings rates, still very, very high. When you think about housing prices, even though interest rates could go higher, the highest we've ever seen, far and away, current home prices are the most they've ever been. Pure goods. Have you noticed you go to a restaurant, in some cases you're paying double what you paid to eat in certain places not but a year and a half ago. I myself was in a New York City restaurant a few weeks back and bought a bottle of Italian wine that was double the price than what I had paid pre-pandemic because the goods can't get here, or like the United States, there's labor issues around the world. So when we think about what's permanent, the goods section of it, things that we use every day that have seen an increase in price are going to stay stubbornly high for a while. You're not seeing the supply chain break and get back to normal till probably 2023, and at that, the first or even the second quarter. The bulk of it will get fixed by second quarter of 2022, but it'll take another additional year to really get things righted. The energy market. The energy market has always been a very speculative place, but you think about energy today, whether it's the UK, Europe, the United States, or China, every single global economy in the world right now is underserved in energy. The United States is down 7% year over year in our supplies. Europe is down 15 to 30%. If you live in Europe, you're going to pay double your home heating bill this winter. In the United States, you're probably going to pay 30 to 50% more than what you paid last winter. So that's a quite interesting phenomenon in that some of this stuff is temporary, some of it is permanent. But this calls into action the Federal Reserve. You see, one of the things that's happened along the way is that the federal government has been very supportive of the US economy. But by doing so and putting so much money into the system, it does create inflation, which some of that we're seeing right now. With the average savings rate at 7.5%, when traditionally it's more like 4%, the consumer is flush with cash. Add to that the amount of money we have in reserves, people just having cash savings, is over $2.5 trillion. Go one further, we have the lowest levels of debt since the 1970s. Now we have a lot of debt out there, but you look at your net worth versus how much debt you have, it's the lowest number since the 70s. Some of this is forced savings. People just couldn't spend their money during the pandemic. Some of it was money they received. Some of it is just simply being concerned about going out and spending on a regular basis. So when we think about that excess amount of money, what does it mean when it comes into the economy? It means costs are going to go higher. Now, if you go to a supermarket and there's 10 people trying to buy one banana, that banana is going to be 10 times higher. If there's 1,000 bananas and 10 people trying to buy them, well, those costs are going to go significantly lower. In this situation, especially in the fourth quarter of the year, when spending is most robust, and we just saw spending data come in for the month of October that far and away beat expectations, you're looking at a scenario where lots of money chasing fewer goods means higher costs. So the federal government now has a role to play. Instead of artificially keeping interest rates low, they've now made the decision that they've got to pivot. So what happened during the pandemic is the federal government went about and printed $120 billion a month. To get at the nuances, it basically, the Federal Reserve bought bonds for the Treasury, and that was then infused into the system. Well, that 120 is now in the month of November being reduced to 105. And they're going to continue to reduce the bond buying program all the way into June of next year, where it'll go to zero. So as we go to zero, it means the federal government, who is the buyer of last resort of American bonds, will no longer be there. That then changes the way interest rates work. As interest rates go higher, generally inflation goes lower after a period of time. Add to that, as I mentioned in the prior slide, I'll go back one for a minute. When you look at the Federal Reserve action today, they've added $3.6 trillion, that blue bar on the bottom, in money that they bought on top of what they already had. Why this is relevant is those bonds mature, just like a CD at a bank. And as those bonds mature, will they buy new bonds with that money, or will they let that unwind? That's the second step in pushing interest rates higher. And then finally, raising the federal funds rate, which is expected to happen at the end of next year. All those should help combat inflation at the same time the supply chain gets unwound, which is why I'm not terribly concerned about long-term inflation. Temporarily, yes, quite a bit of it, more so than what we expect, and you're going to feel pain in a variety of areas for at least the next 6 months, if not 9 months. The things you eat, the things you buy, your everyday life will be absolutely impacted by inflation for the foreseeable future. But because the average consumer is so much flush with cash, they've got money to spend. My lower chart on the right there, how often a dollar changes hands, is critical. Historically, in the United States, a dollar would change hands just by 1.8 times based on when you've earned it. And then if you look at the progression from 1995 down, the velocity of money, how often money changes hands, has collapsed. Now, a lot of that's due to technology. You see, because we have, this fun phone, that all these things that this phone does for us and things we no longer buy, means we're spending less money on traditional goods. But also technology makes us more efficient. You don't use as much gasoline because you're not going to the local store because you bought your goods on Amazon. All those things make the velocity of money go down. And when velocity is low, we have low inflation. When velocity is high, we have high inflation. Notice that we hit some peaks there in the 1980s and again in the early mid-1995 and forward, when inflation was much hotter. My point is, inflation is, as of now, most of it, not all of it, somewhat transitory. However, wages don't come back down. Hard goods that go up don't come back down. Legal fees, consulting fees, doctor fees don't come back down. So there are aspects of it that will stay higher, even though quite a bit of it will come back lower. As the federal government gets out of the way, it is the single most powerful thing happening right now. Because in the midst of a really strong economy, as the federal government gets out of the way, is no longer supportive, the million-dollar question will be, can the economy stand on its own 2 feet? Can the economy now take over from the Federal Reserve and survive without the printing of money. And our expectations clearly are yes, because the amount of money in the system today suggests that this year alone, we're going to see around $850 billion spent in this fourth quarter. We spent $11 billion on Halloween this year. That's the greatest number ever. If we spend $843 billion to be exact in the fourth quarter, that'll be the greatest number ever, as you can see from my progression on the chart below there, the red being this quarter that we're coming upon. And as the consumer spends, we grow. As the consumer doesn't spend, we don't. So having spending being a big part of the future is what's going to drive us forward. It all plays into what's going to happen as far as the consumer psyche. If you're paying, yes.
Was that last chart just pure dollars, or is that inflation adjusted over time?
That's it's both. It's inflation adjusted over time. But certainly you look at the increase in spending on a really rapid basis. Look at the last 2 years, 8.2%, 8.5% to 10%. So you're growing at a much faster rate than inflation, where you're spot on, Christina. The average rate before that was mostly based on inflation. We're growing above the inflationary forecast, which makes it so powerful. I'm rambling on here. Thank you for stopping me, Christina, because sometimes I get going and I don't slow down.
No, I think you've been hitting a lot of the high points, and I definitely think that inflation is probably top of mind for most of our clients. Is the cost of a gallon of paint at Sherwin-Williams is never going to go down. The wages are never going to go down. So there's certain things that are not transitory. And so along those lines, while we're kind of talking about inflation, there's two things I wanted to ask. One, I know you talked about the savings rate, which has really been the saving grace leading into this pandemic, because leading into 2008, the Great Recession, the savings rate was negative. It was about negative 2%, I think, per household. You might correct me if I'm wrong, but I know it was negative. Whereas we had a positive savings rate leading into the pandemic, that's only gotten better. I've heard as of late that that's starting to come down, partially due to inflation. So, is that going to be, at what point should we be concerned with the inflation and the savings rate?
So Christina's point there, you see this, if you see my chart in the upper right here, how much the savings rate was in the middle of the pandemic and how much it's come down. But we're still near double where we were historically. And that's because the consumer has around $2.5 trillion that we're going to spend in this fourth quarter. So having a strong consumer is the basis for economic success globally and domestically, because of the American consumer is 25% of global spending and 70% of US spending. Now, it all plays into unemployment, though. So when we think, I'm going to jump forward here and then come back. When we think about the labor market, it's a critical component to where we're going from an economic success standpoint. So Christina's spot on that as we have extra cash that is spent in the economy, and folks are willing to pay more because they have extra cash temporarily, will we fix the labor market? And it's a quite challenging question. In the month of September, more people quit their job and look for a new job than ever in the history of the United States. 4.4 million people left their job to go find something else to do. What you see here is 10.4 million jobs are available today. And yet we only have 7.4 million people looking for work. So that tells us there's a bit of an imbalance. Now, we saw a really strong scenario in the month of October where over 600,000 people went back to work, but we still get large gaps. Personal experience. Just the other day, I was in a coffee shop in New Jersey, and there was a sign on my way to the cash register, one of those kind of pinup boards, and it said, looking for someone to work the cashier, someone who could be an hourly worker. Jim Cunningham, to get you involved in this conversation, what do you think the starting salary of that cashier was in a coffee shop? The opportunity.
In New York City?
In New Jersey. In the
New Jersey? I don't know, $20.
Close, $15.
Oh.
That number was 50% lower a year ago.
Oh.
That's a significant increase.
Yeah, but Phil, if you think about it, isn't it a good thing to have wage inflation? Living in the United States and having workers make more.
It from an economic standpoint, it does allow the consumer to have a stronger base to spend, but it is a direct hit to earnings power. So when companies spend more, in an inflationary environment on earnings, and they spend more to finance their debt, it takes down their ability to earn, which gets me to the conclusion of where I think the stock market is going, because all these rising costs eventually bring down the ability for companies to earn at a higher rate. That euphoric data I mentioned of 100% earnings growth in the second quarter, 40% in the third quarter, probably 25% in the third quarter. By the fourth quarter of 2022, earnings growth is expected to be 5%. So that's a significant drawdown, and it's because of the costs in the system. However, I would say, to Jim's point, it is powerful that for the first time in decades, we're having real increase in wages. It does bring up the poverty line. It does make the consumer stronger, and it does put us where we can sustain in a more mild growth economy because we have more people that are earning and paying taxes. Notice the chart on the left there. Look how many jobs are open versus jobs that are needed. So in other words, in the current professional and business services, there's 1.8 million jobs open, but only 921,000 jobs that have been filled. So we've got a gap of over 900,000 jobs that still need to be filled there. And it goes down and down and down. In every single sector, we're down somewhere between 30 to 25% of jobs needed in that position. We're still 25 to 30% lower than where we were but a few years back.
So Phil, let me ask you a question. You've been doing this a long time. And I think people are trying, as we collectively go through this whole COVID thing, now a couple of years into it, I think we're trying to kind of dig back into our past and say, when has it been like this before? I personally have come to the conclusion that there's no expert on emerging out of a pandemic. I don't think anyone has any experience on what to do. But, I grew up in the 70s, and that's when inflation was going crazy. It doesn't sound like we're going to go back to that, but I think a lot of people are worried about it. Like, we may go back to a stagflation. How much of a risk is stagflation? Or do you think the Fed's going to get this under control? The federal government and the Fed are going to get it under control?
Three excellent questions. I'll start with the first one. You're absolutely right. No one's ever been through this before. This was an event-driven recession. The last time we had an event-driven recession was Pearl Harbor. A particular event caused the economy to collapse. Generally, recessions are cyclical. They just wind down over time. Things just slow down because they went from hot to cold. Structural, like the banking crisis, a particular portion of the economy broke down. Event-driven, no one has the experience, including me. Use history as our guide. To your second point, is this inflation here to stay, or is it like something we've seen before? Well, certainly the 70s are a comparison that's drawn upon a lot, but this is not the 1970s all over again. There were two things that drove the 70s higher. One, an oil crisis. We do not have an oil crisis right now. There's more global production than ever before. The U.S. is still the dominant producer in the world. And at that, the politics aside, the sort of gouging that's taking place in the oil industry, never taking advantage of a good crisis here to raise prices significantly higher. Venezuela is making money for the first time in over a decade. And there is enough energy to meet demand once supply gets turned back on. And it looks like it's being turned back down. The last 3 weeks, we've seen prices actually come down in oil, not go up, because supply is coming to market and eventually fix itself by next year. But then your last one is this stagflationary? And I don't think so. Stagflation, by the way, everybody, means that interest rates go higher, but wages stay low, or what we earn stays low or goes down. The reason why it's not stagflationary is because the advent of technology and in demographics. You see, we don't spend the way we once did because the bulk of the country's wealth is with people who are over the age of 65. And then you think about technology and our ability to communicate like we are right now. Think about this call. Not but a few years ago, we couldn't have done this call. You would have gotten in your cars, driven to a location. I would have flown in. We set up a room. We'd have a conversation. We'd probably have something to eat. And then you'd go back home. In this scenario, think of all the costs that didn't happen based on what we're doing right now. There was no gasoline used. There's no car driven around. There was no food ordered, unfortunately. There was no place we rented. There wasn't any movement of money whatsoever to have this call. And we're doing it for pennies of what we once did. That is deflationary. And that is why I don't think we get into a stagflation environment where we get runaway inflation and interest rates and the amount of money we earn stays flat. Right now, we are earning, even though we're getting inflation. This is good inflation right now. Think about that for a minute. Don't hang on. Don't throw something at your screen just yet. Good inflation means when we get a lift off in inflation, it supports all aspects of the economy. from an earnings standpoint, wages, from a growth of corporate earnings, and from a asset appreciation. That's all happening right now. Now, you don't want runaway inflation. So here's the key point. Jim would be right that we get in a stagflation environment if these charts in front of you don't start to bend and come back down. These charts are CPI and then PCE, specifically meaning personal consumption expenditure, really the stuff that costs you to buy stuff. And the one in the middle is just pure goods. Notice whether it's goods, your personal inflation in your life, or the stuff you actually buy are all up dramatically. Look how far, I go back to 2012 on these charts and it was flat the whole way. Most of them, we got this massive spike. But with the Federal Reserve getting out of the way, which will then, interest rates will grind higher, forcing inflation to come down. When things get more expensive, generally means we slow down our buying, we slow down our acquiring of debt. It brings interest rates back down over time. And then supply chain gets fixed. And then consumers begin to spend on the money. Christina hit on it. As we have less savings, we're going to spend that much more, that chart in the upper right. So you would only have a real runaway environment of cost if people continue to spend at this excessive rate. And that's just not the case. When savings rates get back to normal, we'll go back to spending at a normal rate. And with the Federal Reserve now getting out of the way, what we'll eventually start to see, this chart represents the federal funds rate. You remember when you used to make money on your savings account? Remember, we used to go to a bank and you would get a toaster when you opened up a savings account as a kid. Well, now you need to give them your toaster because they don't want your money. I joke, but the reality is if you're in Europe, you actually have to pay a fee to keep your money in a bank. In the United States, we're not quite there yet. But this jagged chart graph on the right shows you when you used to actually make money on cash. In 2005, you got a whopping 5% on your cash reserves. Can you imagine that? Today, it's zero, and it's been zero for a long period of time. But that bar, that slight bar on there, if you look at the years on the bottom, starting in 15 and how it escalates up like a staircase and then drops back down, I think we start to look like the staircase again. That the Federal Reserve, by the end of next year, begins to hike rates to where we get back to about 2% on the Fed funds rate. That means the 10-year US Treasury goes to about 3.5%. That means inflation goes back to a normal range of around 2%. If I come back here, see my normal range of 1.8, 1.7, 1.7, probably going to end up right about 2% because of some of the things are permanent. Christina's point about paint, wages, so on, those are permanent. And that's going to push inflation above 2%. And that's actually exactly where the Federal Reserve wanted it to be. So going back to normal means that whether it's the earnings environment, look at that earnings growth on the far right side, where it says earnings growth at 41 there, historic numbers, 91% earnings growth in materials. Why? Because we're making lots of stuff. 29% earnings growth in staples, things that you're buying. 35% earnings growth in financials and healthcare, things that you need. When it gets back to normal, we'll begin to start to talk about what does the stock market act like when things are normal. This chart shows you how cheap or expensive the stock market is. It means we look at the current price of a company and we simply divide it by how much they earn. And the current earnings on the S&P 500 are 25.77. The historical average is 19. Notice Europe's actually below its historical average. That's the green chart just below. And emerging markets are actually right at the historic average at 14. So it means the stock market is not terribly expensive. In the United States, we're a bit expensive, but with interest rates this low, it's not terribly expensive. And it's certainly not nearly as expensive as the bond market. You see, as interest rates go higher, we lose money in fixed income. We don't make money. Eventually, we'll make higher dividends, but the process of going from low rates to high rates is very painful in a bond portfolio. When you think about equity markets, going back to normal isn't a terrible thing, but it also means normal returns. It doesn't mean 25% returns on the S&P 500, 30% returns. Normal in the S&P 500 is 6 to 8%. So normal means we have to be probably more active in your portfolio. Look for opportunities like maybe going offshore where valuations are better. Look for ways to be in maybe small caps and mid cap stocks that can do well in a more sideways environment. So we start to think about what's to come. Going back to normal means you'll start to see things remind you of where they were in the 90s. We'll see before we had the tech bubble. We'll see Normal earnings growth on the S&P 500 of around 5 to 10%. We see a stock market that'll trade in that 5 to 8% range, a bond market that may not be overly accommodative. We actually may lose money in bonds for a couple of years' time. So as the supply chain unwinds, let's talk about right now. First of all, the S&P 500 is in a great time. The fourth quarter is the best time of the year. The average rates of return from the November and December combined are the two best months of the year. So we're already having one heck of a fourth quarter. But don't get me wrong, I wouldn't mind adding a few more percent between the end of the year as we have this euphoric spending by the consumer. And that certainly is well on its way. And we saw in some of the data we already discussed. November being a strong period of time, I don't fear the market. The only thing that will really scare the market to me would be the Federal Reserve misjudging the marketplace and acting too quickly. But actually, Jim touched on something. Is the Federal Reserve going to make a mistake? I think the Federal Reserve has done a wonderful job of learning and understanding, using history as their guide to telegraph the moves they're going to make, let folks know what they're going to do, and slowly unwind the measures they put in place to get us to the other side of the pandemic. In fact, I applaud what they did. We've added a lot of debt to the U.S. balance sheet. I know we're all concerned about the debt, but you realize we're financing it, the total amount of debt, for 1.5%. It's not a lot of money. And if I'm right that interest rates go a bit higher, but then come back to normal, the cost of financing our debt will go up, but not terribly where we won't have discretionary spending for other things in our economy. So all this means is normal is not a bad thing. It means we'll have to go back to maybe normal returns, normal levels of volatility, but normal means we'll still make money over the long term. And for the rest of this year, I think it's a positive outlook. And into next year, a bit more active in the portfolios, looking for ways to earn more yield, accepting that interest rates are going to go higher over time, but know that the equity market may cool off, but not go negative. Why don't I stop there, Christina, see if I can try and answer questions.
Phil, and I know we do have a question, and before we kind of get to the question too, whoops, you got your screen shared still, Phil.
There we go. There we go. Perfect.
All right, there we go. So one of the questions that I think is out there is the Fed is going to run out of tools in their quiver if, and arrows in their quiver to deal with this if they don't act accordingly. Now we've got 2 potential seats going to be filled on the Fed, which could change the makeup of the Fed, being more hawkish and then changing to be more dovish. So what risks do you see with new Fed seats being open?
It's a really great question. The Federal Reserve shouldn't be politicized. They should be looking at economic data and make decisions about how do we get to full employment, and keep prices moderating, not too low, not too high. That's been their mandate since they were created. One of the powers we have as a country is we can manipulate global interest rates and our interest rates based on the power of our Federal Reserve and being the default currency in the world, So in that sense, if we get too politicized and we put governors in place that are going to be, really more into the idea of creating excess levels of debt, it means that it puts pressure on the value of the dollar, inevitably much higher interest rates over the long term. So I do have concerns that the folks who are governors and the seat at the Federal Reserve, Jerome Powell today, should be centrists, understanding that their political wins can help social wins. I get that, but you got to be very careful because the unintended consequence of creating too much debt is that the rest of the world will now frown on the dollar, frown on our levels of interest rates, forcing rates higher. And when I often get the question is, what does keep me up at night? If we're in a scenario where the Fed missteps and gets too political or prints too much debt, we're going to recognize inflation and react to it, and rates push to where they were, to Jim's point, in the 70s of maybe 6-8% on the 10 US Treasury. Now your discretionary spending goes out the door because we only have $2 trillion on an annual basis that we could spend on things besides Medicare, Medicaid, Social Security, and defense. If your payments on your debt go from $600 billion to $1.2 trillion or higher, now you have that much less to spend. And when the government doesn't spend, it's a real headwind to the economy. And we start to look like Japan, who hasn't grown in decades, Europe, who hasn't grown in decades because they're so saddled with debt, they don't have extra money to spend on growing their economy. Europe doesn't have a Silicon Valley today because there was never a private partnership between the federal government and the European banks to be able to create a Silicon Valley. We did. So I would like to see Jerome Powell get the job. I think he's done a brilliant job. I am concerned that he already hasn't gotten the nod. He should have been nominated in September, and we went right through October. Traditionally, that's when the Fed governor gets their renomination. We're already well into November and still no nomination. Now, the president has come out and said that it's because he's got a lot on his plate. He's worried about other nominees as well. But I am concerned that the other person they're considering is much more dovish. And at a time when we don't need more debt, I'd be very concerned if there is more debt. Much of what we talked about today would change. It would be more euphoric for the stock market, but in the long term, create a gigantic asset bubble. And that would really have me worried.
I think that's a good point. And I know that we constantly get the question as to when are interest rates going to go up? And I think that at least at this point, the market's pricing in that they're going to have to probably raise rates sometime Q3-ish next year. So I think that we can all agree that, they're going to have to go up. The question is when. And then if they, as long as they don't misstep, it shouldn't be a taper tantrum. But with yields being so low, and that's the hardest part, being you mentioned fixed income. A lot of times we historically go to bonds just to remove risk out of the portfolio and bring some safety, and also to generate income. But when you're getting 1.5 on a 10-year treasury and you've got inflation at 6.2%, it's a pretty risky thing to be sitting in cash or sitting in fixed income.
That's correct. Well, we all grew up with the free lunch in fixed income. For the last 40 years, we've made anywhere from 5 to 10% in income on our bond portfolio. For guys like me, it was easy. I could just add bonds to your portfolio, and I had an insurance policy if things went bad, and earn 5 to 6%. That's over. So for the first time in decades, and there's not a money manager on the planet that managed money in 1975 that's still doing it today. If they are, they're quite old, and I'd be very surprised. At least if there is, I don't know them. Pay more of her. So in that sense, remember the relationship between interest rates and prices is inverse, like a seesaw. As interest rates go higher, prices of bonds go lower. And the reason why is new bonds that come to market offer a higher yield. So existing bonds have to reduce or go into a discount to be the same kind of yield as the new bonds. And that's why the bond market's down nearly 2% this year. And if I'm right that interest rates are going to go back to normal, inflation goes back to normal. We're at 6 today. We hopefully go back to 2. I will say the month-over-month inflationary numbers are horrifically scary. I tend not to look at the year over year. If I just calculate what the core CPI was for the month of October, it means we're at a 10.9% annual inflation rate. Again, it's because of all the spending and the supply chain. That doesn't all go away, but I think a lot of it does. Point being, though, we're having to adjust how we do things, having to adjust how we manage a portfolio. In our relationship with Christina and Jim, it is that we're having to take on more risk in the equity market, because the bond market, not only is it losing money, we could be in a scenario where we'd see actually an increase in defaults over time, that corporations that didn't manage this quite well may not make their interest payments. So the bond market, which once was a very friendly part of the portfolio, is much more expensive than the equity market. And there's this kind of interesting moniker we use called TINA. There is no other alternative to equities because bonds are losing money and could potentially lose more as rates go higher, except for one piece. When you do get a problem in the marketplace, when, God forbid, another event-driven recession happens, bonds do act like insurance in a portfolio. So instead of being 50-50, you're probably going to have to be 70-30, 65-35. Use other types of investments that can generate income and perhaps provide some security. In your portfolios today, we use investments like the JP Morgan Hedge Equity product, which will allow us to participate in the equity market, but still protect your assets. Our moniker in working with Christina and Jim is we'll want to protect your assets first and then participate second. It's not growth at any cost. It's growth with the measurement and understanding of risks in the marketplace. And that is different today than probably any time we've all been working together, and going to be more different as we go forward.
And we do have a question while we're on interest rates. And if anyone has any questions, please feel free to type them into the Q&A. But one of the questions we have is, why do rising interest rates depress REITs when they have already secured lower rates for their holdings? And I think that there's a distinction too. I'll let you speak to that, Phil, but I think there's a distinction whether it's a traded REIT versus a non-traded REIT, because not always do rates, there's an interesting white paper that was out there years ago that not always do REITs lose value when you're in a rising rate environment. That's not always been the case. But if you want to speak to that a little bit as well, Phil.
A few things impact that. First off, location. What kind of REIT is it? What is it invested in? If you're in a housing REIT, I agree with you. You're not going to lose a whole lot of money because housing prices are skyrocketed and demand is through the roof. But if you're in a New York City building, and right now the occupancy rate of New York City buildings is 29%. That's the highest since post-COVID. There's nobody in the buildings in New York City. That is different scenario. When you have low levels of lease rates, remember lease rates are constantly coming due, it then puts pressure on the price of the REIT or the value of it, because inevitably you have to discount the lease or discount the building to make up for the lack of occupancy. And then you also have to discount it for the fact that higher rates, interest rates, mean that prices of real estate generally go down. And that is simply a correlation to the movement of rates. Now, it also matters what type of building is it? What type of REIT is it? Is it in housing? Is it in multifamily? Is it in quality A buildings? Is it in B buildings or C buildings? But in general, the movement of interest rates higher puts pressure on prices lower, even if they've locked in long-term leases, because even though the long-term lease aspect is one component of it, inevitably there's always lease rollovers. And then in that rollover of it, you may find an individual property or two that has high lease rates. For example, if you're in distribution warehouses in a rising rate environment, you're going to do great, because in a rising rate environment means probably people are making more money and spending more money. But if you're in an area of the marketplace where rising costs are going to diminish occupancy in buildings, well, then you're going to feel pressure. So it's a combination of things that affect this. When I look at REITs, I would say to suggest, don't worry about it. Don't worry about the price. It's somewhat irrelevant. They're a bit like a floating rate note. There's times when the price will go higher, times will go lower. What you want to worry about? Are you getting a fully covered dividend? Is your dividend paid by the income from the REIT? Is it above the safe and security of a 10-year treasury? Is it above the rate of inflation? Or are you willing to take the risk of do that? So often we get lost in the prices of it. It's irrelevant when it comes to real estate. What you want to be relevant about is, am I getting paid to take the risk of the type of property I'm in? And that's where I think Christina has done a wonderful job using the non-traded product and the traded product to generate income. It's an example of where the portfolios will go to generate income away from the bond market to smooth off some of the volatility I expect us to come in the months and years ahead of us.
Phil, I have a question. I view your role, your position as, frankly, it's a futurist. What's going to happen in the future? I mean, in a sense, you care about what's happened in the past, but only as it relates to predicting the future, that your head is in the future. So if you agree with that, my big question for you is, you talk to a lot of smart people. Is there an end in sight to COVID? Will we never go back to normal? Does the world have to get through COVID before the supply chain disruption happens? What are people talking about? What are all the smart kids, so to speak? Is there a consensus? If so, what is it? Or if there isn't, I mean,
Goldman Sachs report just on that topic, and the consensus is that by March of November of 2023, we'll get to 75% of the world being inoculated in one way or another. That's the farthest part out. That means every country in the world. You look at the major countries on the planet, the biggest developed countries, that's spring of 2022. And with most of the supply chain by fall of 2022 falling into 2023. The answer to your question is, you're not done with COVID until at least middle of 2023 for a complete supply chain breakdown. And the fact, for the reality is, whether it's chip manufacturers in Vietnam who are under restrictions to this day, or the African continent, which dealt with this from time to time, Jordan, Bangladesh, case in point, Malaysia right now brings in lots of foreign workers to work on the factory floor in their plants. Because of current breakouts in Malaysia, they've closed down the borders and not letting them in. Now, the vaccine process, and I just read a piece about Invectrum this morning, whether it was a good or bad. The vaccine process, whatever vaccine it might be, is going to have to get us to a point where you see daily cases fall below, and for example, the United States below 10,000 cases per day before there's any kind of normalcy. Where today we're running at 83,000 cases per day. Whether you believe this is the real virus, whether you believe it's only for older folks, obese folks, folks who have premorbidities, or it's just something everyone should be concerned about, psychologically, the reports go on to say that we are not out of this until global cases fall, and using the United States as an example, to a fraction of where we were. So you need to have on case averages be less than 5% of the peak to get back to normal, and we are nowhere near that.
So a couple more years then.
At least.
Okay.
At least.
Thank you.
Questions. You can click on the bottom of your screen. If you like to rather than type, you can raise your hand and I can unmute you and we can have a conversation, which is always fun. Or you can type it into the chat box there. Q&A or chat, we get to see them both. But certainly don't want to ramble on forever here. I want to give you all a chance to jump in if there's a question. I'll ask a question of Christina, though. I am Christina and Jim, you as well. The tax law changes are something that is so much in the forefront of our psyche. Jim, when you think about the legal impact and trust, and what we're running out of time here, right? We have a couple of weeks left in the year, and then you think about the estate tax impact and the potential capital gain, whether it moves or not. Maybe both of you would give some comment on, what the expectations might be around trust law changes and taxes and how they're intertwined, and then we're a race to the end of the year. Are we running out of time?
Yeah, one of the panelists that we were actually trying to loop in and was having some technical difficulties with American funds. They actually were just hosting an hour prior to our call here, an updated call on tax policy. And so the hard part for us, I think, especially Jim and I and our CPA partners, we always like to refer to the partners that we work with as the A team. And, having a real team for any of our clients is critically important, especially as we're dealing with a lot of major tax policy changes. And in coordinating with our CPAs, it's just been back and forth all year. What's the final bill going to be? And then there's constantly horse trades. And so what we do know is that, at least at this point, capital gains rates are not going to be retroactively increased. It seems like the cap gains rates are going to be untouched for 2021. It does seem like the estate tax limits are going to, eventually be changed. They're currently set to sunset in 2025. At the end of 2025, they're set to change. I think income taxes are inevitably going to go up, but a change to the estate tax this year, it seems like that can's been kicked down the road. I don't think it'll happen in January. They're still yet to be seen on the final bill, but it seems like those things it's not hair on fire. We got to get this done by the end of the year.
Yeah, I would say there are three issues you touched on, Christina. One is the SALT cap, the state and local tax cap. That is looking like it may go from 10 to 80,000.
Yeah.
Which is a couple $100 billion over a given period of time. That with reconciliation to pass by 50% plus one, right, which is 50 senators plus the vice president, it has to be revenue neutral. And so what happens is people say, oh, I want this benefit. I want, universal pre-K education, which it's kind of hard to argue with that, right? But you got to pay for it somehow. But what happens in the process is this has to get paid for. And so I feel like they've just been throwing spaghetti on the wall. Like when you make spaghetti, you throw it on the wall, and if it sticks, it's done.
I don't ever throw my spaghetti on the wall, but okay.
Okay, that's what my mother did growing up. She's not a fan. So there you go. But so I would say that they're trying a lot of things, and the SALT cap raising the SALT cap, I think, is really important. I know there was a senator from New Jersey who that's really important for. Secondly, is the death tax increase is going to happen in 2026 under current law. It could be horse traded at the end. We don't know. So a lot of our clients are just being proactive, because guess what? If you've got a larger estate, you're going to have to do this, whether you do it in 2021 or 2025, you're going to do it now or then. And I will tell you, it's only going to get more expensive as we get closer to January 1, 2026, because there just isn't enough labor, frankly, enough trained labor to get the job done. But lastly, this is in the bill. We are anticipating this in the bill is an 8% surtax on income over a certain threshold. Now, for individual income, that's over 25 million. And you might think, well, who in their right, whoever makes 25 million? Well, if you sell a company, you're in that class. Sure. But the worst part of this is when it comes to irrevocable trusts. So this is really important. If a trust has more than $200,000 in income, it's going to be subject to a surtax. If it's over $500,000 in income, it's subject to an 8% surtax. That includes capital gain, as I read the legislation. So it's very important, if you have a complex estate plan, if you've inherited money from a parent or a grandparent and you have these continuing trusts, it's very important to pay attention to it, because your capital gains and income tax rate could very well go through the roof, right? This would be a significant needle moving for a lot of people. So it's something to pay attention to. And it's really, Christina made the point, is the A team. You remember that show from the 80s, and I think there was a recent one, but I'm talking the one with Mr. T. That's our A team. That's the one we like to use. Get your A team together and pay attention. We were meeting with a client earlier this week, and the A team was together, and we had a conversation, and we figured out a way to save the client about $300,000 in income tax this year by not doing much. Okay. It wasn't a lot of effort. It was just looking at it slightly differently. So.
And it took the collaborative effort of having that A team. And I know John, who is my business partner and father, who and I now share an office, but
snuck in behind you by.
He did.
Yeah, he's gonna block it around.
But we refer to it as the three-legged stool. You know, you need your CPA, your estate tax attorney, and your certified financial planner, and it's all a three-legged stool. And if you don't have all three working together, you're going to have imbalance in the plan. And as Jim mentioned, it wasn't any one of us that came up with a solution. It was the collaboration of the three of us working together and multiple heads coming up with a solution to save our client several $100,000 in taxes. So making sure you have a professional team is key. One of the other tax policy items I wanted to mention is back in September, it looked like there was potential to limit Roth conversions. I know we've been dealing with a lot with our clients, and you know, the ticking tax time bomb from all the tax deferred dollars and doing Roth conversions. It was proposed in September that limit will be $100,000 a year going forward. It looks like that can is also, at least at this moment in time, don't know what the final outcome will be, has been kicked down the road to 2029. So we might have some more time to do Roth conversions. So it gives us a little bit longer window to plan over time for our clients to potentially look at low income years to accelerate those tax deferred dollars into lower income brackets. So that's one of the major things that we're planning on with our clients. And, you know, in closing here, because we do have, you know, two quick questions, and if we can keep it brief, Phil, what do you?
I'll go last. You let Jim go first. That's a very important question there. I'll go last. I don't mind.
Which one is the 8% tax?
Yeah. Did you expect estate tax exemption to go down this year?
Oh, I have no idea. And, you know, I wish the Fed would, teach Congress how to signal better, because we don't know what's going to happen. And I really mean this. Like, I talk to a lot of smart people. I talk to people who have their ear on the rail, and I'm telling you, people just, it's like anything can happen. So I think anyone who says, oh, this is going to happen or that's going to happen, I'm not buying it. So
for sure. And I see that question there for me, Christina.
Yeah, that question for you, Phil.
I'll make it real fast. You know, 2022 is going to be a very different year than 2021.
And the question is oil prices too. Sorry, the question just for everybody was just, what do you predict the price of oil to be in 2022?
Thank you. I didn't see that. Thank you. Appreciate that. So two things. First off, some of the spending is going to get pulled forward. So I actually expect 2022 is going to be an okay year. We're going to see some of the euphoric amount of money that we have make its way into the first and second quarter. But usually the second quarter of a presidential term is the weakest. Second year of a presidential team is one of the weakest years. Add to that, we're coming down off the euphoric high. So I would expect the stock market in the first 6 months to probably ebb sideways and maybe be down 3 to 5%, but finish the year at about a +5 to +8% on the year. Lots more volatility as the Federal Reserve gets out of the way. Interest rates push higher. Inflation stays stubbornly high through the first part of next year. It means the market and both equity and bond markets have a real tough first 6 months. I think we get a nice rally into the end of the year as things normalize, and we end up positive, but just a couple of percent. It's a different type of environment, everybody. We're coming from this tremendous amount of spending to going back to normal. Going back to normal won't be bad, but the process of getting to normal might be a little bit more volatile than what we've been used to. Oil, by the way, oil goes back to, I would suggest, $40 to $60 a barrel. I'll give you the medium of 50 by first quarter of 2023. You're on your way back. It's just going to take longer than expected. And that's because of supply. Sorry.
Well, thank you, Phil. Thank you for enlightening us. I know that you've been working with us for many years, and we work collaboratively a lot on our client portfolios. And Phil is the one that helps with his team of analysts orchestrate the allocations as far as their economic outlook and viewpoint. One of the things that I think that they did a phenomenal job with is leading into 2020. No one could have predicted the pandemic. I mean, no one saw that coming. But one of the things that I think Phil has helped us do with our clients, and we came through that exceptionally well, was just looking at the LEI data, the leading economic indicators, which we publish in our, and we post in our weekly economic updates to our clients. It comes out once a month, but the leading indicators were showing a lot of overvalued, euphoric, valuations leading into 2020. So Phil and his team, to their credit, they de-risked by lowering their equity allocation. And then after the March 2020 drop, there was a piece that you guys put out that was talking about event-driven recessions. And if we look at history, and as you spoke to this earlier in our presentation, was there's structural recessions, there's cyclical recessions, and there's event-driven recessions. And event-driven recessions are typically the quickest to recover. And to your guys' credit, you didn't sit idle on cash on the sidelines for too long. After we saw that drop and that entry point in April, May, you guys started adding more equity allocation back to the portfolio. So the number one question I think we got during that time was, do you pull out of the market? Do you sit on the sidelines? This doesn't make sense. If you see, if you see a correction coming, do you get all out? And the question is no, or the answer is no, you don't get all out, but you de-risk and you have an active managed portfolio to get you through it. So Phil's team has helped us with a lot of our clients, and we thank you. And we will have this recorded. So if anyone missed it, this will go out to our clients. And some of the data points that you spoke about, there's a COVID tracker piece that's a purely data-driven piece. We put that in our weekly economic update every week as well. So thank you, everybody. Thank you, Jim. Thank you, Phil. And
happy Thanksgiving, everybody.
Happy Thanksgiving, everybody.
Thanks, everyone.
Bye.